$38 trillion. That's America's national debt right now. Not next year, not some projection from economists with calculators. Actual debt sitting on the government's books as of December 2025. And if you think that number is just abstract financial noise that doesn't touch your daily life, I need you to pay very close attention to what I'm about to show you, because while most of us were busy with our regular lives, scrolling social media, binge-watching Netflix, arguing about politics online, something extraordinary started happening in the world of high finance, something that hasn't happened in 75 years. The largest financial institutions on the planet started moving money, not small amounts, massive sums, quietly, systematically, without press releases or announcements. They're rotating capital out of dollar-based investments and into other assets, other currencies, other jurisdictions. This isn't conspiracy theory territory. This is documented in public filings. You can see it in Treasury Department data. You can verify every number I'm about to give you. The links are in the description. And here's what makes this truly alarming. There's a pattern here, a mathematical pattern that's played out 3 separate times over the last 500 years. Same warning signs, same sequence of events, same devastating outcome. We're watching it unfold again, right now, in real time. The only question is whether you'll recognize what's happening before it's too late. By the end of this video, you'll understand exactly what's going on, why it's happening, and most importantly, what historically comes next. Because the pattern doesn't lie. It doesn't negotiate. It doesn't care about political parties or economic theories or whether you believe in it. It just repeats, like clockwork, like physics, like mathematics. 3 times in modern history, the country holding the world's reserve currency collapsed within 36 months of the smart money starting to leave. Not similar collapses. Identical patterns, same stages, same timeline. Same result. Spain in the 1500s, the Dutch Republic in the 1600s, Britain in the 1900s. All followed the exact same path from global dominance to economic ruin. And every single time, millions of ordinary people asked the same question afterward. How did we not see this coming? The answer? The signs were always there, clear as day, visible in the numbers, obvious in hindsight, but invisible to anyone who wasn't looking at the historical pattern. So let me show you the pattern. Let me show you where we are in the cycle. And let me show you what history says happens next. Because this isn't about fear. This is about information. And the difference between the people who survive these transitions and the people who get destroyed by them comes down to one thing: who saw it coming. Every major economic collapse over the last 5 centuries followed a remarkably consistent pattern. Historians and economists have documented this cycle playing out again and again with eerie precision. Let me break down how it works. A nation becomes the center of global finance. It happens gradually at first, then accelerates. Capital floods in from every corner of the world. Investors, merchants, bankers, everyone wants access to this market because it's the safest, the deepest, the most liquid. The country's currency becomes the standard for international trade. If you're doing business across borders, you need their money, period. No alternatives. Banks expand rapidly, markets boom, innovation explodes, the nation feels invincible, confidence becomes absolute. Everyone believes the prosperity will last forever because it's lasted so long already. This phase typically runs for 5 to 8 decades, long enough that an entire generation grows up never knowing anything different. Phase 2, overextension and excess. Success breeds a particular kind of arrogance. The government starts spending beyond its means. Military adventures, foreign interventions, expensive domestic programs, all funded with borrowed money. Debt grows faster than the economy, but asset prices keep rising. Real estate booms, stock markets hit records. Everyone feels wealthy on paper. The government reassures everyone that the debt is manageable, sustainable, nothing to worry about. Central banks print money to keep the party going. They call it stimulus, quantitative easing, emergency measures. Whatever the label, the effect is the same: more money chasing the same assets. This phase lasts 2 to 4 decades, long enough for the original warnings to be forgotten, long enough for a new generation to assume things will always be this good. Phase 3, the silent exit. This is the critical inflection point, the phase where everything changes but most people don't notice. The smart money sees what's coming. Not the general public, not the politicians, not the mainstream media, just the people who actually read balance sheets and understand historical patterns. Major institutions start quietly rotating capital out. No dramatic announcements, no panic, just steady calculated movement to safer ground. Foreign investors reduce their holdings. Wealthy families diversify internationally. Corporations shift operations to more stable jurisdictions. The exodus begins slowly, then accelerates. This phase is deceptively short, 18 to 36 months from beginning to end. Blink and you miss it. By the time it becomes obvious to everyone, it's already too late to exit at favorable prices. Phase 4, the collapse, the currency loses its reserve status. It doesn't happen with a single announcement. It pens gradually as more countries settle trade in other currencies. The tipping point comes when the majority of international transactions no longer require the dominant currency. Foreign central banks start selling their holdings, not because they want to hurt the country, but because holding the currency has become a liability rather than an asset. The money floods back home. All those dollars or pounds or reals that were circulating globally come rushing back into the domestic economy. That's when inflation goes from concerning to catastrophic. Interest rates spike, asset prices crash, banks fail, pensions evaporate. The middle class, holding most of their wealth in the currency and domestic assets, gets completely wiped out. And everyone asks the same question: how did we not see this coming? The answer is always the same. The pattern was there. The data was public. The warning signs were clear. But most people don't study history. They don't look at patterns. They assume their moment in time is unique. It never is. Let me prove this pattern is real, not with theory, with history. With 3 empires that followed this exact cycle to its inevitable conclusion. We start in the 1500s with Spain, the most powerful nation on earth. No debate, no competition, absolute dominance. Spanish galleons were returning from the Americas loaded with more gold and silver than Europe had ever seen, ship after ship carrying literal tons of precious metals. The wealth seemed infinite. The flow seemed permanent. The Spanish real became the global reserve currency. If you wanted to conduct international trade anywhere in the known world, you needed Spanish reals. Madrid became the financial center of Europe. Money flowed in from every direction. Phase 1 complete. King Philip II controlled half of Europe. Spanish armies were considered unstoppable. The Armada ruled the seas. Colonies stretched across 3 continents. The Spanish Empire seemed eternal. And what did they do with all that wealth? They spent it on everything. Wars with France, wars with England, wars with the Ottoman Empire, wars with the Dutch, a massive military presence spanning continents, a bureaucracy that consumed fortunes, royal palaces that cost kingdoms, the Spanish Inquisition burning money along with heretics. By 1550, government spending was running at 300% of revenue, 3 times what they collected in taxes. The difference was borrowed from Italian banks, German merchants, anyone who would lend. But gold kept flowing from the New World. Asset prices in Spain kept rising. The economy looked strong on the surface. Everyone felt rich. The empire seemed invincible. Phase 2 verified. Then something changed, quietly, without fanfare or headlines. In 1555, major Spanish banking families started moving assets to Genoa. The Fugger family, Spain's biggest creditors, began demanding repayment in gold instead of promises. They wanted out. They wanted hard assets instead of government guarantees. By 1556, wealthy merchants were transferring operations to Amsterdam, not shutting down in Spain, just opening offices elsewhere, moving inventory, redirecting trade routes, gradually shifting their center of operations. Why would they do this when Spain looked so strong? Because they could read the financial statements. And the statements revealed something terrifying. Spain was functionally bankrupt. The Spanish government was paying 40% interest on some loans. 40%. That's not a sign of strength. That's desperation bleeding through official documents. The smart money saw what was coming and started moving. Not all at once. Gradually, quietly, exactly like Phase 3 predicts. 1557. Spain defaulted on its debts for the first time. Credit markets froze overnight. Spanish bonds became worthless pieces of paper. The government seized private gold shipments to pay soldiers because they'd run out of money. Chaos spread through the financial system, but the king promised it was temporary, a one-time problem. Everything would be fine once things stabilized. 1560. Spain defaulted again. 1575. Again. 1596. Again. 1597. Again. Destroying more wealth. Each one eroding more confidence. Each one making recovery harder. The currency collapsed. Inflation destroyed the middle class. Savings evaporated. The Spanish economy never recovered its former glory. By 1600, Spain was a shadow of what it had been just 50 years earlier. The golden age was over, forever. It never came back. Spanish power evaporated like morning fog. The empire that seemed invincible, that seemed eternal, that everyone assumed would last forever, collapsed under the weight of its own debt. Phase 4 complete. And where did all that money go? Where did the wealthy families, the international merchants, the smart money end up? North, to Amsterdam, to the Dutch Republic. The cycle was beginning again. The next reserve currency was rising, and the pattern would repeat with mathematical precision. The 1600s belonged to Amsterdam, the richest city in the world, not just in Europe, in the entire world. By every measure, the Dutch East India Company was worth $8.2 trillion in today's money, more than Apple, Microsoft, Amazon, and Google combined. Times two, one company. That's how much wealth was concentrated in Dutch hands. Dutch banks financed global trade. The Amsterdam Stock Exchange was the first in history, pioneering concepts of public share trading that we still use today. The guilder became the world's reserve currency. International business required guilders. There was no alternative. Capital flowed into Amsterdam from everywhere. Asia, Africa, the Americas, Europe. If money wanted to find returns, it found its way to Dutch banks. Amsterdam in the 1600s was Silicon Valley, Wall Street, and London combined into 1 square mile. Phase one? Undeniable. Then came the wars. It's always wars. Always overextension. Always the same trap. 3 Anglo-Dutch wars between 1652 and 1674. Constant conflicts with France. Ongoing struggles with Spain. The Dutch maintained military presence from Indonesia to Brazil to South Africa, and it all cost money, staggering amounts of money. Government debt increased from 4 million guilders in 1650 to 80 million by 1690, a 20-fold increase in 40 years. How did they pay for it? They printed money. Does that sound familiar yet? Meanwhile, something bizarre was happening in the markets. Tulip mania hit Amsterdam like a fever. Tulip bulbs were selling for more than houses. A single rare bulb could cost 10 times what a skilled craftsman earned in an entire year. Asset prices completely detached from any economic reality. Everyone was getting rich on paper. Everyone was convinced they'd found the secret to permanent wealth. It was revolutionary, they said. The new normal, they said. This time is different, they said. The Bank of Amsterdam, supposedly the safest institution in Europe, was secretly lending out depositor money to fund government wars. They were running what we'd now call fractional reserve banking before anyone had invented the term. It was essentially a Ponzi scheme wrapped in legitimacy and respectability, new deposits paying old withdrawals. As long as everyone didn't want their money at the same time, the illusion held. Phase 2 complete, 1690. The smart money started moving. Major banking families began transferring operations to London. The Sephardic Jewish merchants who'd made Amsterdam wealthy started relocating. Portuguese traders opened offices in England. German financiers pulled capital out quietly over several years. Why? What did they know? They knew something the public didn't, something the government was desperately trying to hide. The Bank of Amsterdam was broke. Had been since 1672. They'd been operating on fraud for decades, using new deposits to pay old withdrawals while secretly lending to the government. But the secret was kept until it couldn't be kept anymore. Phase 3 verified. 1795, French revolutionary armies invaded the Netherlands. The Dutch Republic fell. The guilder collapsed overnight. The Bank of Amsterdam's fraud was finally exposed to the world. Depositors lost everything. Riots broke out in the streets. Political chaos consumed the nation. The Dutch Golden Age ended not with a whimper but with violence and chaos. 150 years of dominance, gone in months. Just like that, the institutions that had seemed permanent, the wealth that had seemed eternal, the power that had seemed unbreakable, all disappeared almost overnight. Phase 4 complete. And the capital, the wealth, the financial power that had made Amsterdam the center of the world, it didn't disappear. It just moved to London, to Britain, the next empire rising to dominance, the next reserve currency taking its place on the global stage. The pattern was continuing, the cycle was repeating, and nobody seemed to notice that the same stages were playing out again with perfect precision. Now we come to the most recent example, the one that matters most because it's closest to our current situation. The British Empire. The sun never sets on the British flag. You've heard that line. Everyone's heard that line. It was true for over a century. At its peak, Britain controlled 23% of the world's population, a quarter of Earth's land mass. The empire spanned every continent except Antarctica. British power seemed infinite, eternal. The pound sterling was the global reserve currency for over 200 years, longer than any currency in modern history. The City of London was the center of global finance, unchallenged and unchallengeable. Need capital for anything anywhere in the world? You went to London. British banks financed railroads in America, mines in Africa, plantations in Asia, infrastructure on every continent. Over 60% of international trade settled in pounds. The gold standard itself was built around sterling. Nations defined their currencies in relation to the pound. Britain didn't just participate in the global economy. Britain was the global economy. British power seemed permanent, a fact of nature, something that would last forever, phase one absolute. Then came the 20th century and two catastrophic world wars. World War I cost Britain £44 billion. That's over $600 billion in today's money. They borrowed from America. They borrowed from their own citizens. They borrowed from anyone who would lend. Government debt went from 30% of GDP to 130%. Remember that number, 130%. The same level America is approaching today. They tried desperately to stay on the gold standard. It was a matter of national pride, a symbol of British power. But economics doesn't care about symbolism. They abandoned gold in 1931, tried to return briefly, failed again in 1933. The system was breaking. The mathematics wouldn't work anymore. World War II made everything catastrophically worse. More debt, more printing, more promises they couldn't keep. Britain ended the war technically victorious but financially destroyed, broke, dependent on American loans to survive. The empire had won the war but lost the future. Phase 2 complete, 1949. The quiet exodus began. Major British corporations started moving operations to America. Unilever, Shell, British Petroleum. They weren't shutting down in Britain, just shifting investment, redirecting capital, building more aggressively elsewhere. Wealthy British families transferred assets overseas, to Switzerland, to America, to Canada, to anywhere that offered better prospects than overtaxed, overregulated, declining Britain. The brain drain accelerated dramatically. Scientists, engineers, entrepreneurs, academics, anyone with skills and options looked at Britain's trajectory and chose to build their future somewhere else. Britain offered high taxes and declining prospects. America offered growth and opportunity. The choice wasn't difficult. By 1960, foreign investment in Britain had fallen 62% from pre-war levels. The money was leaving, the talent was leaving, the future was leaving. Phase 3 confirmed, 1967. The E-pound was devalued 14.3% overnight. One day you go to sleep, and the next morning your currency is worth 14% less than it was yesterday. The British government had no choice. They'd run out of foreign currency reserves trying to defend the exchange rate. The game was over. The mathematics had won. 1976, Britain went to the International Monetary Fund for a bailout. A bailout, read that again. The former global superpower, the empire on which the sun never set, the nation that had financed the world for 2 centuries, had to go begging for emergency loans like a developing nation. The humiliation was complete. The decline was undeniable. The pound lost its reserve currency status. International trade shifted to dollars. Britain's century of financial dominance ended forever. Phase 4 verified. 3 empires, 3 reserve currencies, spanning 500 years of history. Spain, the Dutch Republic, Britain, all followed the exact same pattern, same stages, same sequence, same outcome. Rise to dominance, overextension through debt, silent exodus of capital, catastrophic collapse. The cycle repeated with such precision you could almost set your watch by it. And now, let me show you why America is walking the exact same path, step by step, stage by stage, with mathematical precision that should terrify anyone paying attention. 1944, Bretton Woods, New Hampshire. Representatives from 44 nations gathered to rebuild the global financial system after World War II. They make a decision that will shape the next 80 years of history. The US dollar becomes the world's reserve currency. Not the pound, not the franc, the dollar. Why? Because America had won the war, because Europe and Asia were in ruins, because American industrial capacity was intact, because America held most of the world's gold reserves. The dollar was backed by gold at $35 per ounce. Other currencies were pegged to the dollar. The system had a built-in anchor, a mathematical constraint. You couldn't just print unlimited money because you had to maintain gold convertibility. Capital flooded into America. U.S. markets became the deepest and most liquid on earth. Everyone wanted American assets, stocks, bonds, real estate, treasury securities. The golden age of American financial dominance had begun. This lasted from 1945 to 1971, 26 years of absolute, unquestioned dominance. Phase 1 complete. August 15, 1971. President Richard Nixon appears on television and announces that the United States is ending gold convertibility. The dollar is no longer backed by anything physical. It's now pure fiat currency, just paper, just trust, just faith in the US government. And what happens when you remove all constraints? When you take off the last remaining brake? Spending explodes. 1980, US national debt is $900 billion. It seems like a huge number at the time. People worry, economists warn. Politicians promise to address it. Watch what happens next. 1990. $3 trillion, 2000. 5.6 trillion, 2008. 10 trillion, 2020. 27 trillion, January 2025. 36.1 trillion, December 2025. 38.4 trillion. That's a 4,200% increase in 45 years. The debt more than doubled in just the last 5 years alone. But that's only government debt. That's just the federal balance sheet. Let me show you the complete picture. Corporate debt hit $13.5 trillion. Household debt, $18 trillion. Student loans, $1.77 trillion. Credit card debt, $1.1 trillion. Auto loans, $1.6 trillion. Medical debt, hundreds of billions. Total U.S. debt, public and private combined, exceeds $100 trillion. That's 370% of GDP. For context, let me remind you what happened historically. Spain defaulted when debt hit 200% of GDP. The Dutch Republic collapsed at 250%. Britain lost reserve currency status at 130%. America is at 370%. And climbing. Now, here's where it gets really disturbing. The government now pays over $981 billion per year just on interest payments. Not paying down the debt itself, just interest, just the cost of borrowing. That's more than defense spending, more than Medicare spending, more than most entire government departments combined. Nearly $1 trillion every single year just to service existing debt. And how do we pay for that? We borrow more. We print more money. The Federal Reserve expands its balance sheet. The cycle continues. The M2 money supply increased from $15.5 trillion in February 2020 to $21 trillion by April 2022. That's a 40% increase in 26 months. The largest monetary expansion in American history, ever, by far. What does massive money printing create? Inflation, asset bubbles, wealth inequality spiraling out of control. The stock market hits all-time highs while real wages for workers stagnate. Housing prices are up 73% since 2019. Price-to-earnings ratios at dot-com bubble levels. Everything inflated. Every asset class simultaneously overvalued. The Federal Reserve's balance sheet went from $800 billion in 2008 to $9 trillion in 2022. They bought everything. Treasury bonds, mortgage-backed securities, corporate bonds, propping up asset prices artificially to prevent the system from collapsing under its own weight. This is textbook Phase 2 behavior. Overextension, excess, spending beyond means, printing money to sustain the unsustainable. Asset prices disconnected from economic fundamentals. And here's the critical question that should keep you awake at night. Who's buying all this new debt? Not foreign governments. As we'll see in a moment, they're selling, not buying, not private investors. They're demanding higher yields because they see the risk. Increasingly, the U.S. government is buying its own debt. The Federal Reserve creates money and uses it to purchase treasury bonds. The government prints money to buy bonds from itself. It's circular financing. Printing money to cover deficits created by printing money, that's not a sign of strength. That's not normal market function. That's the financial equivalent of writing yourself checks from an account that has no money in it. Phase 2 isn't just happening. It's accelerating. The debt is growing faster than the economy. The printing is accelerating. The mathematics are becoming unsustainable. And if you know the pattern, you know what comes next. The smart money starts leaving. 1944, Bretton Woods, New Hampshire. Representatives from 44 nations gather to rebuild the global financial system after World War II. They make a decision that will shape the next 80 years of history. The US dollar becomes the world's reserve currency. Not the pound, not the franc, the dollar. Why? Because America had won the war. Because Europe and Asia were in ruins. Because American industrial capacity was intact. Because America held most of the world's gold reserves. The dollar was backed by gold at $35 per ounce. Other currencies were pegged to the dollar. The system had a built-in anchor, a mathematical constraint. You couldn't just print unlimited money because you had to maintain gold convertibility. Capital flooded into America. U.S. markets became the deepest and most liquid on Earth. Everyone wanted American assets, stocks, bonds, real estate, treasury securities. The golden age of American financial dominance had begun. This lasted from 1945 to 1971. 26 years of absolute, unquestioned dominance. Phase 1 complete. August 15, 1971. President Richard Nixon appears on television and announces that the United States is ending gold convertibility. The dollar is no longer backed by anything physical. It's now pure fiat currency, just paper, just trust, just faith in the U.S. government. And what happens when you remove all constraints? When you take off the last remaining brake, spending explodes. 1980, U.S. national debt is $900 billion. It seems like a huge number at the time. People worry. Economists warn. Politicians promise to address it. Watch what happens next. 1990, $3 trillion, 2000, $5.6 trillion, 2008, $10 trillion, 2020, $27 trillion, January 2025, $36.1 trillion, December 2025, $38.4 trillion. That's a 4,200% increase in 45 years. The debt more than doubled in just the last 5 years alone. But that's only government debt. That's just the federal balance sheet. Let me show you the complete picture. Corporate debt hit $13.5 trillion. Household debt, $18 trillion. Stewed. NT loans, $1.77 trillion. Credit card debt, $1.1 trillion. Auto loans, $1.6 trillion. Medical debt, hundreds of billions. Total U.S. debt, public and private combined, exceeds $100 trillion. That's 370% of GDP. For context, let me remind you what happened historically. Spain defaulted when debt hit 200% of GDP. The Dutch Republic collapsed at 250%. Britain lost reserve currency status at 130%. America is at 370% and climbing. Now here's where it gets really disturbing. The government now pays over $981 billion per year just on interest payments. Not paying down the debt itself, just interest, just the cost of borrowing. That's more than defense spending, more than Medicare spending, more than most entire government departments combined, nearly $1 trillion every single year, just to service existing debt. And how do we pay for that? We borrow more, we print more money, the Federal Reserve expands its balance sheet. The cycle continues. The M2 money supply increased from $15.5 trillion in February 2020 to $21 trillion by April 2022. That's a 40% increase in 26 months, the largest monetary expansion in American history, ever, by far. What does massive money printing create? Inflation, asset bubbles, wealth inequality spiraling out of control. The stock market hits all-time highs while real wages for workers stagnate. Housing prices are up 73% since 2019. Price-to-earnings ratios at dot-com bubble levels. Everything inflated. Every asset class simultaneously overvalued. The Federal Reserve's balance sheet went from $800 billion in 2008 to $9 trillion in 2022. They bought everything. Treasury bonds, mortgage-backed, securities, corporate bonds, propping up asset prices artificially to prevent the system from collapsing under its own weight. This is textbook Phase 2 behavior. Overextension, excess, spending beyond means, printing money to sustain the unsustainable, asset prices disconnected from economic fundamentals. And here's the critical question that should keep you awake at night. Who's buying all this new debt? Not foreign governments. As we'll see in a moment, they're selling, not buying. Not private investors. They're demanding higher yields because they see the risk. Increasingly, the U.S. government is buying its own debt. The Federal Reserve creates money and uses it to purchase treasury bonds. The government prints money to buy bonds from itself. It's circular financing. Printing money to cover deficits created by printing money, that's not a sign of strength. That's not normal market function. That's the financial equivalent of writing yourself checks from an account that has no money in it. Phase 2 isn't just happening, it's accelerating. The debt is growing faster than the economy. The printing is accelerating. The mathematics are becoming unsustainable. And if you know the pattern, you know what comes next. The smart money starts leaving. Now let me show you what's happening right now. Not speculation, not theory, documented capital movements that you can verify yourself in official Treasury Department records. China held over $1.3 trillion in U.S. Treasury securities back in 2013. Today, $757 billion. They've sold over $300 billion worth in the last decade. That's documented. That's public record. You can look it up yourself. But here's what's interesting. This isn't panic selling. This is strategic, calculated repositioning. They're not dumping everything at once. They're systematically reducing exposure over time, exactly like Phase 3 predicts. Japan has been the largest foreign holder of U.S. debt for years. As of March 2025, they held $1.13 trillion. But even Japan has been adjusting. In April 2025, following certain trade policy announcements, they sold approximately $20 billion in a single month. Saudi Arabia has reduced holdings, Belgium reduced its position, Switzerland, France, multiple countries quietly shifting their portfolios, not making dramatic announcements, not trying to crash markets, just steadily, methodically moving capital. And it's not just foreign governments. The Federal Reserve itself has been doing what they call quantitative tightening. They're reducing their own balance sheet, letting bonds mature without reinvesting, draining liquidity from the system. So here's the question that should concern everyone. If foreign governments are reducing their holdings and the Federal Reserve is stepping back, who's buying all this new debt that America keeps issuing? Increasingly, the answer is circular financing. Government agencies buying from other government agencies. Pension funds forced to buy because they have no other options for supposedly safe assets. A closed loop that looks increasingly fragile. Now, I need to be precise about something important here. This isn't a wholesale panic exodus. The situation is more nuanced than simple abandonment. Foreign demand at some recent treasury auctions has actually been quite strong. Overall foreign holdings have fluctuated rather than collapsed in a straight line. .br. What we're seeing is a shift, a rebalancing, a diversification away from concentrated dollar exposure. That's different from complete abandonment, but the direction of movement matters. The trend is clear even if the pace is gradual. .br. Major financial institutions are adjusting their strategies too. BlackRock, the world's largest asset manager with over $10 trillion in assets under management, has been shifting portfolio recommendations. More emerging market exposure, more international diversification, less concentrated dollar dependency. JP Morgan has restructured institutional allocation guidance. Goldman Sachs has adjusted equity recommendations. Morgan Stanley has increased international allocation suggestions. These aren't panic moves. These are strategic repositioning decisions by institutions that manage money for the world's wealthiest individuals and largest organizations. Bridgewater Associates, one of the most sophisticated hedge funds in the world, has been warning about dollar devaluation risks for years and has positioned portfolios accordingly. This is Phase 3 behavior. Not dramatic, not headline-grabbing, just quiet, systematic, calculated movement by people who read balance sheets professionally and understand historical patterns. The smart money isn't running for the exits. They're walking toward them, calmly, deliberately, but they're definitely moving. And here's what history teaches us about this phase. It doesn't last forever. Phase 3 has a timeline, 18 to 30 to 6 months historically from the beginning of serious capital rotation to the point where it becomes obvious to everyone. If we mark the beginning as when foreign selling notably accelerated, which would be roughly mid-2024, we're now about 12 to 18 months into what historically is a 2 to 3 year window. That doesn't mean collapse is guaranteed tomorrow, but it does mean the clock is ticking, the pattern has a pace, and we're somewhere in the middle of Phase 3 right now. The question isn't whether this is happening, the data proves it is. The question is what comes next and how quickly it unfolds. Now, let me address something you might have seen circulating online. In June 2024, there were widespread reports that the petrodollar agreement had ended, headlines everywhere claiming a 50-year deal had expired. Let me give you the actual facts because this matters for credibility. Fact checkers confirmed there was never a formal written treaty requiring Saudi Arabia to price oil exclusively in dollars. What existed was an informal arrangement, an understanding that grew out of 1970s negotiations. The 1974 U.S.-Saudi Joint Commission on Economic Cooperation did expire, but that was a framework for economic cooperation, not a binding petrodollar contract. However, and this is the important part, Saudi Arabia has recently indicated willingness to accept other currencies for oil transactions. They've explored yuan-denominated deals. The practical effect is real, even if the sensational headlines oversimplified the mechanism. The dollar's exclusive grip on energy markets is loosening. That's documented. But it's happening through gradual bilateral agreements and market evolution, not through the expiration of a single agreement that never technically existed in the form reported. This distinction matters because accuracy builds trust. The underlying trend, the weakening of dollar dominance in oil markets, is real. but we need to be precise about how and why it's happening. When you see claims that seem too dramatic, verify them. The truth is usually more complex and more interesting than the headline. Based on the historical pattern we've documented, let me walk you through what economists and historians suggest could happen if this cycle continues to its conclusion. I'm not making predictions. I'm showing you scenarios based on what happened the previous 3 times this pattern played out. Scenario 1, the gradual erosion. The dollar doesn't lose reserve currency status overnight. Instead, an increasing percentage of international trade settles in other currencies. China and Brazil trading in yuan. India and Russia settling in rupees. European nations conducting more business in euros. BRICS nations, which now represent over 40% of global GDP, continue building alternative payment systems. Each bilateral agreement is small, but they accumulate. The dollar's share of global trade drops from 70% to 60% to 50%. Not in a week, over years, but the direction becomes undeniable. As dollar demand gradually decreases, all those dollars held in foreign central banks and international trade slowly return to the U.S. economy. That's when inflation becomes a serious problem. Not overnight hyperinflation like Venezuela, more like persistent, elevated inflation that destroys purchasing power over time. The Federal Reserve faces an impossible choice. Raise interest rates high enough to control inflation, which would make the $38 trillion debt essentially unpayable and crater the economy, or keep rates lower and accept persistent inflation that erodes savings and living standards. Either path creates pain, just different kinds of pain. Scenario 2, the credit crisis. Interest rates rise because lenders demand higher returns for the risk of lending to a heavily indebted nation. Higher rates mean higher interest payments on the debt. Higher interest payments mean larger deficits. Larger deficits mean more e-borrowing. More borrowing means even higher rates. The debt spiral becomes self-reinforcing. At some point, the market decides the risk is too high. Credit spreads blow out. Suddenly, the government can't borrow at anything close to reasonable rates. That's when you get forced austerity. Not chosen, forced, because the money simply isn't available at any price the government can afford. In this scenario, asset prices deflate rapidly because liquidity disappears. Stocks crash, real estate values plummet, bonds default. Banks that are heavily exposed to these assets fail. Pension funds holding government bonds become insolvent. Insurance companies collapse. The cascade effect hits the middle class hardest because that's where most wealth is held in dollar-denominated assets. Retirement accounts, savings, home equity, all losing value simultaneously. Scenario 3, the managed decline. This is the optimistic version. Political leaders and central bankers manage a controlled, slow devaluation of the dollar. They carefully balance inflation against growth. They implement structural reforms. They reduce spending gradually. They raise some taxes. They somehow thread the needle. It's painful. Living standards decline. America becomes less wealthy relative to other nations. But it's managed decline rather than chaotic collapse. Is this scenario possible? History suggests it's the least likely. Managed declines require political courage and long-term thinking that democracy typically can't sustain. But it's theoretically possible. The point is this: all 3 scenarios involve significant economic pain. The only question is what form that pain takes and how it's distributed across society. Now I know what some of you are thinking. You're thinking, but America, it's different. We have the strongest military in history, the most advanced technology, the best universities, the most innovative companies. Silicon Valley. The dollar is entrenched globally. This time won't be the same. Let me respond with history, not opinion. Spain in the 1500s had the most powerful military on earth, unstoppable armies, the greatest navy ever assembled, didn't prevent economic collapse. Military power couldn't overcome mathematical reality. The Dutch Republic in the 1600s had the most advanced financial technology of their era. They literally invented modern capitalism. Stock markets, central banking, options trading, futures contracts. They pioneered it all, still collapsed when the debt became unsustainable. Britain in the 1900s had the largest empire in human history, global trade networks, industrial revolution, scientific advancement, the Royal Navy ruling every ocean. The sun literally never set on their territory. None of it prevented the pound from losing reserve status when the economic mathematics stopped working. Technology doesn't override mathematics. Innovation doesn't eliminate debt. Military power doesn't create wealth. And exceptionalism is a story empires tell themselves before they fall. Every empire throughout history believed it was different. Every reserve currency nation thought their moment was unique. They always had reasons why the old rules didn't apply to them. They were always wrong. The pattern doesn't care about narratives, doesn't care about potential, doesn't care about military strength or technological advancement or cultural influence. It cares about mathematics, debt to GDP ratios, interest payments as a percentage of revenue, currency supply versus economic output, capital flows. These are numbers, and numbers don't negotiate. You can believe American exceptionalism if you want, but the debt is still $38 trillion. The interest payments are still nearly $1 trillion annually. Foreign holders are still reducing positions, and the pattern is still unfolding exactly as it has 3 times before. So let's talk about what this means for you practically. Not theory, not macroeconomics. What should you actually do with this information? First, diversify out of concentrated dollar exposure. If substantially all your wealth sits in dollar-denominated assets, stocks, bonds, cash, real estate paid for in dollars, you have concentration risk. Not might have, do have. Consider assets that historically hold value during currency debasement. Gold has been a store of value for 5,000 years across every civilization. Silver, other precious metals, commodities, real assay, TS that can't be printed into existence by central banks. I'm not saying sell everything and buy gold. I'm saying diversification isn't optional anymore. It's risk management. Second, consider geographic diversification. If major institutions are moving capital internationally, that's information worth considering. Not all your money, but some portion. Research stable foreign currencies. Swiss francs have a long history of stability. Singapore dollars are backed by excellent fiscal management. Norwegian kroner are supported by sovereign wealth funds. Spread political risk across multiple jurisdictions. Third, understand the timeline. Phase 3 historically lasts 18 to 30 to 6 months. If we're currently 12 to 18 months in, that suggests you have time, not years, months, maybe a year or 2 at most if the pattern holds. Use that time wisely. Don't panic, don't make emotional decisions, but don't assume you have unlimited time to adjust either. Fourth, increase liquidity. Keep accessible cash despite inflation. Yes, it loses purchasing power sitting in a bank account, but in a crisis, liquidity gives you options, the ability to buy crashed assets, the ability to move quickly when opportunities appear, the ability to cover expenses if other assets are temporarily inaccessible. Illiquid assets trap you exactly when you need flexibility most. Fifth, reduce personal debt. High debt in a rising rate environment is dangerous. Every point that interest, rate, increase makes your debt more expensive to service. If you're highly leveraged on mortgages, car loans, credit cards, consider reducing that exposure now, while you can do so on your terms rather than having it forced on you. Sixth, invest in yourself. The one asset that survives every collapse throughout history is human capital. Skills that create value, knowledge that solves problems, relationships built on trust and reciprocity. These can't be inflated away. They can't be confiscated. They can't be devalued by central banks. In every collapse, the people who survive and thrive are those with valuable skills and strong networks. Seventh, stay informed. The people who survive these transitions are the ones who see them coming early, who understand the patterns, who don't wait for mainstream media to confirm what's already obvious in the data. The information exists. The pattern is documented. The choice is whether to pay attention or not. These aren't guarantees. These are risk management strategies based on historical patterns. Your situation is unique. Your risk tolerance is personal. But ignoring concentration risk because you hope the pattern won't repeat this time is a choice with potential consequences. So here we are, $38 trillion in debt and counting. Foreign central banks quietly adjusting their positions. Major institutions repositioning portfolios. All the warning signs of Phase 3. This isn't conspiracy theory. This is documented CAPI. TAL flows, public filings, treasury data, numbers you can verify yourself. Everything I've shown you is sourced in the description. The pattern has repeated 3 times over 500 years. Spain, the Dutch Republic, Britain, same cycle, same stages, same outcome. We're watching it unfold again right now. The only question is whether you're seeing it or whether you'll be asking later, like millions before, how you missed all the signs. The information is here, the pattern is clear, the data is verifiable, the choice is yours. Drop a comment below. Tell me what you think, where you agree or disagree, what you're doing to prepare, what questions you have. I read every comment. And hit that subscribe button because the next video goes deeper. I'm breaking down exactly Which asset classes historically performed best during currency crises? What protected wealth? What destroyed it? What happened to real estate during Britain's collapse? What happened to stocks during every major currency crisis? Because the pattern repeats. The cycle continues. And if you understand the pattern, you can position yourself accordingly. This isn't about fear. This is about information, about pattern recognition, about understanding that history doesn't repeat exactly, but it does rhyme. The people who survive these transitions aren't always the ones with the most money. They're the ones with the best information and the courage to act on it. Thanks for watching. The pattern doesn't care. If you believe in it, it just unfolds. Every single time